Jacobo, Ahmed, thank you for being here today. I hope you're enjoying the beautiful day here in Miami. To Insignio, good afternoon, guys out there. Ahmed today gave me the honor of acting as host to this panel conversation, so thank you for that, Ahmed. In any case, it's great having you here. The objective of today's call and conversation is to talk a little bit about the Insignio SMAs, Unimar and Insignio working together with Unimar in this particular project. So as an initial question, Ahmed, and maybe you can hit it off and then Jacobo can fill in. Why did Insignio decide to set up a proprietary fixed income SMA program?
Yeah, so we decided to do this, number one, really driven by customer demand. We got a lot of reverse inquiries into brokers and FAs, or investment professionals as they're known today, that wanted basically a bond portfolio that would be managed professionally by a group full time, that they could actually see the positions, sort of like let's say the average account at Insignio for many years consisted of bond portfolios with individual bond positions picked by the advisors, managed by the advisors, researched by the advisors, followed up, those kinds of things. So what we've noticed is there's been a large pickup in demand for this to be professionally managed, so advisors could actually concentrate on getting even more assets. So what we're seeing is that they wanted to outsource the investment management portion of their bond holdings to someone else, so they can concentrate on growing their book and not have to be a slave to markets, a slave to research, the way that we think you have to be in order to put these bond portfolios together in an appropriate way.
Of course, and there's always credit risk when you do individual portfolios. Jacobo, do you want to chime in?
Well, actually, I fully agree with Ahmed. I think that over time, people have realized, financial advisors have realized that, choosing bonds off of an Insignio, sort of best of breed list is really not the same as a properly structured portfolio where you're taking into account the individual risk tolerance of every different client, the level of volatility that you want in the portfolio, and having the ability and the resources to manage and follow up on the credit risks of every individual credit. I mean, that is really it's not even a single person's full-time job. I think it's a team's full-time job. And Unimar happens to be in that business. We've been in business for 12 plus years, essentially as a fixed income specialist, registered investment advisor. And my personal experience extends, more than twice that long. So we are in the business of putting together portfolios, monitoring credit risk, and finding the proper combination of risk tolerance and volatility for different clients based on the client's risk appetite. So what we've done is pick 4 different levels of risk within a fixed income portfolio structuring, and offered those 4 levels on the assumption that most Insignio clients will fit any one of those levels, and based on the fact that Unimar actually manages individual portfolios with those exact characteristics today.
Jacobo, let me ask you a question. Is it easy to pick bonds? I mean, if we produce like a bond list with hundreds and hundreds of names out there, is it easy to select one security from that list, or is it tricky? Does it take skill to select bonds?
I don't think it's that hard to pick one security. I think that what's very challenging is to create a portfolio, because a portfolio in essence, is a combination of securities that tries to balance the weighting of geographies, of industries, of duration, meaning the blended maturity of the portfolio, and then tracking how those credits are performing over time. And in order to do that, you either need a team of 50 people that are specialists in all types of corporate asset classes, or you need to be buying research, which costs upwards of 6 figures a year, which we do. We are purchasers of several credit services that cost very close to $100,000 a year, where we get daily multiple reports on how the individual corporate credits are doing, such that we can pick improving credits and get out of credits that are deteriorating in quality. So, if you have the team, if you have the time, if you have the expertise, it's totally doable. We do it, and several other professional registered investment advisors do it. But again, the key word here is portfolio, not individual bond, because it's a whole different ballgame, right?
Yeah, and just to add on to what Jacobo said, because Jacobo has really focused, because the way that we've divided it here internally at Insignio for this product is that Jacobo and his team really focus on the credit and portfolio construction, and we and my team really focus on the overlays, let's say, the duration calls, which are very important, and they're very key to a bond portfolio, because as we saw last year firsthand, if you get the duration call wrong in a bond portfolio, it could be catastrophic, right? It could be where you see returns in a bond portfolio pretty much match what you see on the equity side, which is something that, again, we don't think that's a new normal, let's say. So I want to be clear on that. We don't expect in fact, we've actually, part of the reason why we started these portfolios now, not just because of the reverse inquiry, but because we did see a good opportunity for fixed income to outperform and be one of the better performing asset classes is here, something that we still believe to be the case. So it's all those things put together, right? It's not just credit risk. It's not just about picking the names, balancing out the industry risks, seeing which credits are improving, which ones are deteriorating, but it's also managing duration. It's how these things interplay with one another that really makes a successful bond portfolio at the end of the day.
Perfect. And having said that, and as you said, you moderate the duration of the portfolio. We know that the Fed just did what appears to be the last rate hike. I don't know if you agree with me there, that there's a lot of talking about that. Is duration going to be an issue going forward?
So let me address that. I think that the overlay to the answer to the question has to be where we stand, both from Insignio's point of view and for Unimar's point of view. From Unimar's angle, I believe we have seen the last of the rate increase. I also agree with Ahmed that I don't think what the market is telling us, which is that by the end of the year, there's going to be at least 1 or 2 interest rate reductions. I don't think that will necessarily happen. I think that the Fed will stay put. And the reason I believe that is because I believe also that the reduction in inflation will be a little bit harder and take a little longer. So on the assumption that there are no more rate increases and maybe the rate decreases start sometime in 2024, this is an ideal pivot time to be entering into maybe longer duration than you would usually take if you were defensive. Why? Because we believe that at this stage, there's a greater risk of interest rates coming down over time. And therefore, if you lock into a portfolio, current yields with a reasonable duration, you will probably benefit not just from the yield of the portfolio, but from capital gains as the treasury curve starts decreasing in performance.
Right. And just to add there, our view to start the year, which we continue to hold, which is that the bond market doesn't need the Fed to cut rates to have a good year. Even with a pause, that would be a benign outcome for the bond market. So the only situation where we see where bonds will get hit from here would be the case that the Fed actually has to increase rates more than the market currently expects. And like you mentioned, the market currently believes that's it, that was the last rate hike. The market's pricing in right now, as we speak, a 7% chance of a 25 basis point rate hike. So basically the market believes that's it, we're paused. And they are already pricing in basically a 50% chance of a rate cut by July. And by the time we get to November, it's 100%. Now, to Jacobo's point, whether you agree with the market or not, it doesn't change the case for bonds, because even in the case of a pause, you won't get as much, let's say, market price action in your favor, but you'll get the carry, which is still very attractive on the fixed income side.
Understood. Now, shifting a little bit to Unimar's story and track record, because again, Insignia selected Unimar as its partner in this venture. Jacobo, can you tell us a little bit about Unimar's story and their track record managing bonds?
Sure. So I prior to Unimar, I worked for over 20 years in the industry, focusing primarily in fixed income. I founded a firm back in the early 90s, which was Vestrust Securities. It was purchased by Dresdner in 2001, 2002. It was repurchased by EFG during the EFG period. I was the CEO of a registered investment advisor, as well as the president of EFG Securities. So lots of experience. And in 2011, at the end of 2011, I decided to open my own firm, go back on my own, and really give a different angle to how I managed investments. And I was committed to managing it only as a registered advisor, meaning only charging assets under management, not transactionally. And I launched a bond fund as our first project. And that was really the flagship of Unimar, is the Unimar Total Return Bond Fund. The bond fund has a 60% investment grade, 40% high yield restriction. So that fits into what the flavor at Insignia is labeled conservative plus. And that is really where we have a 12-year track record, which is GIPS compliant and has been beating the benchmark throughout. So, we have a blended benchmark, which is 60% investment grade, 40% high yield. And it's been quite a rewarding experience. I think that when you have a larger portfolio, such as the fund, you're able to buy bonds that have a larger minimum denomination. There's a lot of attractive bonds with minimum of 200,000. You have the ability to hedge interest rates from time to time. You have the ability to leverage. So in our case, we custody at JP Morgan. We have a leverage contract with JP Morgan. We do the interest rate bridging with them as well. But that can be synthesized into as little as a $500,000 portfolio with a few caveats compared to what we do in the bond fund, right? Because if you have a $500,000 portfolio, you need necessarily to stay away from bonds that have a minimum 200,000. Leveraging can be a little more complicated, particularly if you go 100% aggressive, because high yield bonds don't have a borrowing capability at Pershing. But most of our inquiries come from Insignia clients that want to see bonds in their portfolio and that want to see the interest coupons paid in the portfolio and have a risk profile that fits into those four categories. So it's something we're very comfortable doing. And as I said, we have a proven track record that speaks for itself. And we have a team of 4 professionals, which are dedicated to monitoring credit risk, supervising the portfolios on a daily basis, and really doing what is needed to make sure that people get the best service and the highest quality monitoring and portfolio management possible. Now, I'd like you to segue into the fees at one point, Alejandro, because I do believe that it's important to detail to our listeners what the fees entail and what they cover, because it's really not just paying for the management of the portfolio.
Definitely, and we can talk a little bit about fees, and that perhaps I was thinking about an interesting question because when you talk about advisors here at Insignio, you talk to Insignio advisors about SMAs. Sometimes the operational complexity of the structure comes up, meaning that it's easier to invest in a mutual fund than in an SMA. Can you talk a little bit about the advantages of doing an SMA versus a mutual fund?
Well, first of all, it really, can I say that it's better to have a portfolio where you see your individual bonds rather than buying a fund like the Unimar bond fund? No, I think that it's truly the preference of the client, right? A lot of clients don't like to see a single line that says Unimar bond fund, DoubleTree bond fund, PIMCO bond fund. They want to see the 20, 25, 30, 40 bonds, and they want to see those coupons coming in every few weeks. For those clients, it's the perception of what they own and seeing the risk that is being taken that I think becomes very positive, right? But in my heart of hearts, is it better to have a portfolio than a fund? Not necessarily. You can do as well if the fund is well managed and if the fund profile fits your own risk profile. But historically and for comfort reasons, a lot of clients want to see their individual bonds.
And also, like I would add, you also have the capability or the flexibility on the SMA side to manage what the final costs are to the client, right? Which is something that in a bond structure you don't. So that's why what we typically see is that the larger accounts, the bigger accounts, tend to prefer to go the SMA route because they can manage the costs much more to the end client. But like Jacobo said, it's really a preference. I mean, the investment management side is the same. It makes no difference whether you're in an SMA or a bond fund, as long as it's the same manager pursuing the same strategy. It really comes to, like how he mentioned, to personal preference of the client and also the potentiality for having a different cost structure to the client.
Which brings up the item of fees, right? Because typically in an SMA, you don't have the fund formation cost, you don't have the administrative expenses, so it tends to be less pricey than within the mutual fund. I think you wanted to touch a little bit on that, Jacobo, correct?
Yes, obviously, if you're running a fund, you want to know that you have a top class administrator so that when you redeem or you subscribe, it happens smoothly and professionally. You want the fund to have a well-recognized auditor who audits the results and guarantees that what you are being told by the fund manager is in fact what's happening. So that is obviously an extra cost that is built into a fund and could take away a few basis points from a simple SMA where all you see and all that the client gets charged is the wrap fee that the financial advisor and the client agreed to. On our end, I think it's very, very important to understand what of the 50 basis points that the combination of Insignio and Unimar are charging, what do they include? Because it can sound expensive or inexpensive based on what it is that we're giving you with that fee. So obviously you're getting the investment management know-how and the ability to put together the portfolios and monitor them and keep track of what the clients want at that risk level. That's a given. But those fees also include two very important costs that the client is really paying very inexpensively. One are the trading costs. Insignio's trading desk has committed to only charging 5 basis points a year on a portfolio. That's extraordinarily inexpensive. And nobody can get that because once if you want to trade a bond, the trading desk will typically make between 10 and 25 basis points per trade. Here you have a commitment of only 5 basis points So essentially every trade is flat and their fee is incorporated in the 50 basis points. The other element is that there's no platform fee additional charges. It is also included in the 50 basis points. So you have access to Adapar and all of the reporting that the Adapar software gets you for your client, essentially slicing the portfolio any which way from any point in time to any other point in time from a performance point of view, reporting based on different industries, geographies. In essence, the most sophisticated performance software that we have found for the benefit of your client. So you're really getting a lot of punch for your money in that sense.
Understood. And it's interesting talking about pricing because at Insignia, we have a managed accounts platform. And when you look at the total costs of third-party SMAs, it comes up to be similar to the Unimar expenses. So just, wanted to mention that because I thought it's important. Talking about a little bit about the strategies. So as you said, there's 4 flavors from conservative to aggressive. Can you expand a little bit on the 4 flavors? Why? So it seems it's a risk. It's a credit play. I mean, the riskier you get, the higher the percentage of yield of high yield bonds you get in the portfolio. Can you expand on that?
Yeah. Yes, I think that's a beautiful topic because to me the key word is not just credit risk. The key word is volatility. The higher the component of high yield in a portfolio, the more volatile your returns are going to be month to month. In the medium to long run, yes, you're going to get a higher yield, but that higher yield is going to come at a volatility cost that can be perfectly tolerable by certain clients and absolutely nauseating for other clients. So if your profile of a client is somewhat conservative, but very low tolerance for up and down movements in performance, you want to take that client to the highest possible combination of investment grade, because the more investment grade bonds you have in a portfolio, typically the lower volatility you will have, and you will be definitely, having a happier client. Now that has to be in combination with duration, right? So if you have a client that is obsessed with volatility and they want to see as little movement as possible, you go to a very short duration and 100% high yield, investment grade. On the other hand, you can go longer duration, all high yield, and you can make your return in a couple of months of the year, and the rest of the months are going to be going up and down. So if the clients are okay with that, then I would say, go with a higher high yield component. But people tend to forget about volatility, and it's what makes clients nervous. So it's not just credit. To me, credit is a given. We're going to monitor high yield credit just as carefully as investment grade credit. And I'm extremely comfortable with all of our high yield names in the portfolio because we're really never getting even close to the sort of B- and below levels of high yield. We only play in the B or better category. And a lot of those names are very well managed. A lot of those companies have solid management teams and they're very comfortable with the level of leverage they have. But the market will treat it with higher volatility, and that's something that you need to be perfectly cognizant of.
Understood. Perfect. I do want to remind the audience that you guys can submit questions via the chat or the Q&A box here in Zoom. Ahmed, would you like to chime in on what Jacobo was just mentioning about high yield and how you guys as a team feel comfortable with the space?
Yeah. So, our sense is that, high yield is a part or could easily be a part of clients' portfolios. Some clients need it and want it. But like Jacobo said, I think the key when you only focus on one side of the equation, one side of the coin, which is return or yield in this case, is that you perhaps don't realize what the cost of that yield is right? And the cost of that yield is more volatility. So we always think it's prudent, whether it's the fixed income SMAs or even the regular IMFs. We like to start the conversation with volatility rather than what return do you want in the account, or what yield do you want in the account, is how much volatility are you willing to tolerate, right? And volatility is different than risk, in a sense that what you don't want is if you have a mismatch in volatility between what the portfolio is and what the client expects it to be, that's when volatility becomes risk, because that's when volatility becomes a permanent loss of capital when the client sells because it's down way too much for their liking. And then that's when we all get into trouble, because then they realize those losses and they make those losses permanent. Instead of it being a feature, then it becomes actual loss of capital, which is what we want to avoid in all cases, right? We want to avoid capital loss as much as possible. That should also go without saying. But so managing high yield requires, let's say, a little bit more emphasis, and managing volatility on the high yield space requires that much more emphasis and due diligence in credit research. Again, not to say that on the IG side that's not necessary, but it's a greater component of the overall performance because you have higher default rates in the high yield space than you do in the IG space. So yeah.
Yeah, but some people, what some people say right now is that what you get with high yield is like a marginal spread nowadays, from the standpoint that, again, even investment grade yields are very high nowadays, right? And I mean, when you compare, like, what high yield is really yielding to current high, long duration investment grade, it seems that the spread is somewhat small. Any comments on that?
No, actually, currently the spread is about 3%. So it's substantial, right? I can put together in an hour an investment grade portfolio that will have a very modest level of volatility, and it's going to get you 5.25 to 5.5 all day long. So if people are happy with that and they have low volatility, that's a very nice level of return that is going to be steady, and you'll see very little up and down from a portfolio volatility point of view. Can I get an 8.25 on a high yield portfolio? Absolutely. That's what, on average, some of these high yield names are yielding. But you're going to get, as I said, you could be in an extreme position where all of your return happens in a couple of months, and the other 10 months of the year, you're just bouncing, right? If that's something you don't want to deal with, I would say you should be in the 3 better flavors and not in the full high yield flavor.
Understood. One question from the audience: if someone wants to present the portfolio but show track record, what would be the best portfolio to present, and how could they present it, given that this is a relatively new program?
Right. So the SEC played a number on all of us, and they came up with something called the new marketing rule. And the new marketing rule, in essence, says unless your client is a pension fund or unless your client is an institutional investor, for individual clients, you can only present actual performances of actual accounts. So, we have done fund management for about 12 plus years, and we only started doing individual SMAs in the last couple of years. So the longest track record, the easiest to present, the more professionally we can give it to you, is the Unimar bond fund. Now, it's going to have the Unimar label. Why? Because Insignio, as a separate RIA, does not have its own fixed income individual account performance. So it can be explained. I mean, we don't control it. The SEC, has decided that, they don't want RIAs presenting model portfolios because, in fact, there's a lot of variability between one portfolio and another based on how big the fees or how little the fees are. So We're happy to provide either the actual portfolio returns of all of the flavors, which is essentially, what we've managed on an individual account basis, but the three other flavors separate from Conservative Plus are going to have a much shorter lifespan because we only started doing it no more than a couple of years ago.
Understood. Question to you both, going into a specific sub-asset category. Are bank preferreds of an investment grade bank high yield or investment grade?
Are investment grade preferreds? Are they investment grade or preferreds? So you mean, do we disagree with the rating agencies?
So rather
than
that, in an investment grade portfolio, reformulating the question, in an investment grade portfolio, would you do preferreds of banks that are rated investment grade?
Well, here's the tricky part, right? Anything that says dividend in Bloomberg, a non-US investor cannot buy because they're going to get hit with a 30% withholding. Yeah. So most preferred issuances, because I don't want to call them bonds, have the equity component of having their payments labeled as dividends. So for a non-US, which I think is a great majority of the potential investors, that's out of the question, unless they're willing to submit a tax return and claim, pay taxes and do the claims that some people do. But otherwise, from a bank paper point of view, we go into typically junior subordinated bonds, and we're very careful to read the actual, portfolio. The PPM, the memorandum, to make quadruple sure that they are treated as interest payments. And some junior subordinated issuances are investment grade and some are not investment grade. So you have both.
Understood. And you like the bank space to invest in?
I do. Listen, I've been asked that recently more often than not because of what's happened, with some of the banks that have failed recently. And here's the sort of fact that you cannot run away from. Approximately 40%, 40, of all of the corporate bonds outstanding in the world are issued by financial institutions. So if you want to have a representative portfolio based on the universe of bonds, your portfolio will have at least 40%. If it has less, then you're actually, by definition, underweighting financials in your portfolio, right? We like to have portfolios with no more than 30% in any one industry. So we will typically look for 30% of the portfolio to be in bank bonds. But the banks that we pick are not even regional. I mean, we're looking only at the systemically important bank.
Understood. And having asked that, are you benchmark agnostic, or do you try following a specific benchmark to keep specific asset categories within a specific?
I am 100% linked to benchmark. I think that any manager that says I don't pay attention to benchmark is doing it for a very convenient reason, so that their performance cannot be relatively measured. I mean, the Unimar Bond Fund from day one created a blended benchmark, which had a 60% investment grade weight and a 40% high yield. And we will benchmark every one of the four portfolios to their risk profile. I think you have to benchmark it to know how well you're doing it for the clients. Are we doing a good job? And if we're not doing a good job, we should be, fired. I don't know. I mean, why keep a manager if they're not beating or matching the benchmark, right?
Understand. Yeah, totally. I agree with you there. Ahmed, so we're already beyond the 30 minutes, and I know Ahmed, as usual, the common moderator of these calls, likes to keep them at 30 minutes. So following the rules of the game, any final comments, Ahmed, on the strategy, on why you feel confident that this is a right space to go into?
Well, look, our two teams interact all the time. We have beyond the sort of daily constant communications between Jacobo and myself, our teams meet collectively together once a week. Because as you all know, we also sort of co-manage or sub-advise, I should say, the Focused Growth Fund. So we have now several years of working together. We think it's a good combination, and we think we each sort of bring specific domain knowledge and expertise that helps to complement what each side is doing. And we thought that the fixed income SMA, especially given the level of demand for it from the client side and where the investment environment is for fixed income, we thought it was almost a no-brainer to launch this product. So we're very happy to bring it to everyone. We hope everyone takes a look at it and is able to see the value that's provided over time, and sort of sees the value for many clients of seeing the bonds in their portfolios, the coupons coming in, and what we think ultimately is a cheaper cost to the end client versus some of the other structures that are out there.
Understood. Thank you. Jacobo, your closing remarks?
I think that we can truly add value, and I believe that for the price that is being charged, getting a yearly trading fee of 5 basis points is almost unheard of. If the portfolio is focused to match the risk tolerance of the client, I think it's a huge win-win. I will say our mantra in picking credit is credit improvement. For us, the secret sauce is having corporate names where the risk of the company issuing the bond is decreasing over time, which means the spread will shrink, which means the bond has a higher potential of increasing in price. So we're looking for capital appreciation at the same time as yield. It's not just the yield. And to do that, you need improving credits in the portfolio.
Understood. Perfect. Well, anyway, guys, thank you so much for being with us today. Enjoyed the conversation and have a great afternoon. Enjoy the rest of the day.
Thank you very much.
Take care. Have a great day. Insignia Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Advisor Public Disclosures website, https://advisorinfo.sec.gov/.